Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. July closed with headline equity indexes still positive for the year, but the path underneath those numbers became less comfortable. The S&P 500 was up 9.4% year to date through July 31st, and the Nasdaq was up 9.2%. Yet July also brought a meaningful rotation away from high momentum technology and semiconductor shares. That is a useful reminder that a strong index can conceal a more uneven market. MRA's investment committee sees an economy that is still expanding, but one that is asking more of portfolio construction. Growth has slowed from earlier in the year, inflation has improved unevenly, and long term interest rates remain elevated. The result is a constructive but balanced posture. Stay invested with purpose, emphasize quality and diversification, and keep enough liquidity to respond to volatility without turning it into a forced decision. Second quarter real GDP grew at a 1.5% annualized pace. That headline is slower than the prior quarter, but it does not tell the whole story. Private domestic demand grew at a stronger 3.9% annualized rate, supported by consumer spending and business investment. Retail sales and real personal consumption expenditure data also pointed to continued spending resilience in June. The labor picture is more mixed. Payroll growth slowed to 57,000 in June, while unemployment held near 4.2%. Low claims suggest that layoffs remain limited, but slower hiring and softer confidence deserve attention. For investors, this is not a clean recession signal. It is a reason to favor businesses with durable cash flow, sensible balance sheets, and the ability to protect margins when growth becomes less uniform. June brought better monthly inflation readings, with headline CPI down 0.4% for the month and core CPI flat. The year over year picture remains more challenging. Headline CPI was 3.5%, headline PCE was 3.7%, and core PCE was 3.3%. Those levels are still meaningfully above the Federal Reserve's 2% objective. That distinction matters because it limits the case for a rapid shift to easier monetary policy. The Federal Reserve held its target rate at 3.50% to 3.75% in July, maintaining a data dependent stance. Energy prices, geopolitical developments, services inflation, wages, and tariff related pressure could all keep the road to lower inflation uneven. For portfolios, the higher for longer risk is clearest in long duration assets, highly leveraged businesses, housing sensitive areas, and expensive growth stocks. It is also why high quality short and intermediate bonds deserve a larger role than they did when yields were scarce. Income is once again a meaningful part of total return, not just a defensive afterthought. July's rotation into software, financials, energy, and defensive exposures came as some of the market's largest technology names became more volatile. That shift can feel uncomfortable when a familiar group of leaders pauses, but it is constructive if it expands the number of companies and sectors supporting returns. Concentration remains an important risk. A narrow group of mega cap names has had an outsized effect on index behavior, which can leave investors exposed when leadership changes. Strong second quarter earnings have helped support sentiment, but headline results were also influenced by unusually large company specific gains. The more durable test is whether earnings breadth, recurring cash flow, and balance sheet quality improve across a wider set of businesses. The 10-year Treasury yield ended July near 4.75%, and broad U.S. bonds were modestly negative for the year. Higher yields have pressured longer maturity bonds and valuation sensitive equities. They also raise the hurdle for companies that rely heavily on refinancing or external capital. Heavy Treasury issuance may keep term premiums elevated, while geopolitical escalation or shipping disruptions could put renewed pressure on energy costs. Credit spreads remain contained, which suggests no acute stress today, but refinancing costs are still higher than many borrowers have become used to. That combination supports a selective approach to credit, favor investment grade quality rather than reaching for yield in weaker balance sheets. Uneven conditions do not eliminate opportunity, they change where an investor needs to look for it. Broader market participation can improve diversification beyond the largest technology companies. Businesses with durable free cash flow, pricing power, and a disciplined capital structure may be better placed to navigate a period in which financing is more expensive and the economic backdrop is less uniform. Productivity investment is another area worth watching. Artificial intelligence, automation, and infrastructure spending have the potential to support long term earnings and efficiency, but the investment case will not be identical across every company associated with those themes. The committee is more interested in the businesses that can turn investment into recurring cash flow than in simply owning the most popular name in a fast moving narrative. Fixed income also offers a more useful opportunity set than it did when yields were near historic lows. Short and intermediate high quality bonds can provide meaningful income while limiting some of the interest rate sensitivity that comes with extending too far out the maturity spectrum. That does not make duration risk disappear. It gives investors more ways to balance income, liquidity, and resilience. Finally, volatility can create disciplined entry points. A pullback does not automatically make an asset attractive, and a rally does not automatically make it overvalued. But when prices move, a written allocation plan gives investors a way to act with intention. Add to an underweight that still serves a real portfolio role, reduce a position that has become too large, or maintain a reserve for a known near term need. The committee's work is not to predict every market move, it is to test whether the assumptions inside a portfolio still make sense. Are long term yields adequately reflected in equity and bond valuations? Is inflation continuing to improve or merely pausing? Is earnings growth broad enough to support the market or concentrated in a few exceptional results? Are consumers and businesses still spending from a position of strength? These questions help separate a temporary headline from a change that may warrant action. For an individual investor, the equivalent questions are more personal. How much of the portfolio may need to support spending in the next few years? How much market movement can you tolerate without changing course at an inopportune time? Has a successful holding become a larger share of your wealth than intended? Does the mix still support retirement timing, tax planning, business decisions, or family commitments? A market outlook has value when it sharpens those decisions, not when it adds more noise to them. The committee's work is not to predict every market move, it is to test whether the assumptions inside a portfolio still make sense. Are long term yields adequately reflected in equity and bond valuations? Is inflation continuing to improve or merely pausing? Is earnings growth broad enough to support the market or concentrated in a few exceptional results? Are consumers and businesses still spending from a position of strength? These questions help separate a temporary headline from a change that may warrant action. For an individual investor, the equivalent questions are more personal. How much of the portfolio may need to support spending in the next few years? How much market movement can you tolerate without changing course at an inopportune time? Has a successful holding become a larger share of your wealth than intended? Does the mix still support retirement timing, tax planning, business decisions, or family commitments? A market outlook has value when it sharpens those decisions, not when it adds more noise to them. The committee's work is not to predict every market move, it is to test whether the assumptions inside a portfolio still make sense. Are long term yields adequately reflected in equity and bond valuations? Is inflation continuing to improve or merely pausing? Is earnings growth broad enough to support the market or concentrated in a few exceptional results? Are consumers and businesses still spending from a position of strength? These questions help separate a temporary headline from a change that may warrant action. For an individual investor, the equivalent questions are more personal. How much of the portfolio may need to support spending in the next few years? How much market movement can you tolerate without changing course at an inopportune time? Has a successful holding become a larger share of your wealth than intended? Does the mix still support retirement timing, tax planning, business decisions, or family commitments? A market outlook has value when it sharpens those decisions, not when it adds more noise to them. The committee's work is not to predict every market move, it is to test whether the assumptions inside a portfolio still make sense. Are long term yields adequately reflected in equity and bond valuations? Is inflation continuing to improve or merely pausing? Is earnings growth broad enough to support the market or concentrated in a few exceptional results? Are consumers and businesses still spending from a position of strength? These questions help separate a temporary headline from a change that may warrant action. For an individual investor, the equivalent questions are more personal. How much of the portfolio may need to support spending in the next few years? How much market movement can you tolerate without changing course at an inopportune time? Has a successful holding become a larger share of your wealth than intended? Does the mix still support retirement timing, tax planning, business decisions, or family commitments? A market outlook has value when it sharpens those decisions, not when it adds more noise to them. MRA's current allocation view favors a neutral to selective overweight in U.S. equities, with an emphasis on quality, free cash flow, pricing power, and broader sector exposure. International developed markets remain neutral, with valuation support balanced against growth and currency risks. Emerging markets warrant selectivity rather than a broad, unfiltered allocation. Within fixed income, the committee favors high quality short and intermediate maturities. Long duration treasuries can still play a role, but they should be added selectively. While inflation and supply risks remain elevated, cash is not a verdict on the market. It is a strategic reserve that can meet known spending needs and provide the flexibility to rebalance when volatility creates opportunity. The practical discipline is simple, even when the environment is not. Do not chase a narrow group of winners. Do not let a single market move rewrite a long term plan, and use pullbacks to test whether your allocation still matches your objectives. A portfolio designed around your time horizon and cash needs is better positioned to absorb uncertainty than one built around the latest headline. August's calendar puts several pressure points into view. Manufacturing and services activity will help clarify business momentum. Employment data, unit labor costs, and jobless claims will shape expectations around the labor market and wage pressure. The July CPI release will be a critical test of inflation progress, while retail sales will offer another read on the consumer. Our base case remains a moderate expansion with uneven inflation improvement. Corporate earnings can support equities, but elevated long term rates and changing leadership are likely to keep volatility above the unusually calm levels seen earlier in the cycle. A stronger outcome would pair faster disinflation with broader earnings participation and stable yields. A weaker outcome would combine renewed energy led inflation with softer labor and consumer data, pressuring both valuations and credit appetite. A monthly outlook is a framework for judgment, not a reason to overhaul a sound long term plan. The same market condition can have very different implications for a retiree drawing income, a business owner preparing for a liquidity event, and a family investing for goals decades away. The useful question is not whether the market is about to move in one direction. It is whether your portfolio has the appropriate mix of growth, income, and readily available reserves for the decisions you may need to make. This is particularly important when headline returns are positive. A portfolio that has drifted toward one concentrated winner may look successful until leadership changes. Rebalancing is a way to bring risk back to the level you intended, often by trimming what has grown beyond its role and directing capital toward areas that have become underrepresented. It is a discipline, not a prediction. Likewise, a higher yield environment does not eliminate the need for equities, and equity volatility does not make cash the answer to every concern. Each part of a diversified allocation has a job. The committee's view is that those jobs are becoming more differentiated, which makes intentional portfolio construction more valuable than simply following the best recent performer. That is also why investment decisions should not be made from a single calendar reading. Monthly data can be revised, market returns can reverse quickly, and even a well supported base case can be overtaken by an unexpected policy or geopolitical development. A durable plan leaves room for that uncertainty. It identifies what is essential, what is flexible, and which changes would actually justify a fresh decision. For many investors, the most productive response to a changing market is a structured review rather than a dramatic move. Confirm the purpose of each account, the role of each major holding, the amount of cash required for near term obligations, and the tax consequences of any change before acting. That process can turn a volatile month into a useful checkpoint instead of a source of unnecessary regret. Monthly market data becomes useful when it is connected to the choices in front of you. MRA helps clients coordinate investments with cash flow needs, taxes, retirement timing, insurance, and long term goals so that market movement does not force a short term reaction. If you would like to review whether your allocation still fits your financial picture, meet with an MRA advisor. At MRA Advisory Group, we believe successful investing isn't about predicting every short term market movement. It's about building disciplined portfolios designed to achieve your long term financial goals while managing risk through changing market cycles. Periods of uncertainty are normal. History has consistently shown that investors who remain disciplined, diversified, and focused on their long term objectives are typically rewarded over time. Thank you for watching this month's market update. If you'd like to review your investment strategy or receive a complimentary second opinion on your portfolio, we'd welcome the opportunity to speak with you. I'm Marco Lima on behalf of everyone at MRA Advisory Group. Thank you for your continued trust, and we'll see you next month. Stay calm, stay invested, and let us know if we can assist you further. Visit mraadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website